Welcome to the Opening Bell Report.
Okay, let's unpack this. Picture the scene. It's a Tuesday morning. You're sipping your coffee. You open up your brokerage app and you see it. Micron technology ticker MU. It is just sitting there at an all-time high. I mean, we are talking over $435 a share.
Yeah, up big.
Up 6% in a single day. And even after the bell, it's still ticking up.
It is the moment every investor dreams of, right? All green.
Absolutely. But then, almost immediately, that little voice in your head kicks in, that lizard brain.
The fear of heights.
Exactly. You start thinking, this has to be the top. This is, too good to be true. I got to sell. I need to sell right now.
Take the money and run.
Take the money, buy a boat, run for the hills, and just never look back.
It's a classic trap, a very real, very powerful psychological vertigo at the top. You feel like you need to escape before the market realizes its mistake.
Right. But before anyone listening right now slams that sell button, we need to just hit pause for a second. We have to talk about a specific document that landed on our desk. We are looking at a really comprehensive stock analysis report. It's dated January 29, 2026. And it has a massive flashing warning light attached to it.
And that warning is pretty counterintuitive given what we just said about the price.
Completely.
It says selling now would be a massive mistake.
Which sounds absolutely insane when you're staring at record highs.
Yeah.
But the report, it centers on this one big concept, the AI memory supercycle.
Right.
And the core argument is that we aren't at the end of the party. We're not even a last call. According to this analysis, we are only in the third inning.
The third inning. I like that analogy. It implies we have, most of the game still left to play?
A long way to go. It suggests that this run up to 435 isn't the peak. It's just the warm up.
Okay.
So that is our mission for this deep dive. We're going to tear this report apart and figure out if that optimism is actually grounded in reality or if it's, just hype.
And we have to explain why a price-to-earnings ratio that looks terrifying might actually be a bargain.
And why Micron's cash flow, which, let's be honest, used to be a disaster, is suddenly looking weirdly like a software company's.
And we absolutely have to address the "this time it's different" argument, because in finance, those are usually the famous last words.
They usually are. So let's start right there. I want to challenge this. If you have followed Micron for more than 5 minutes, you know this company has a reputation.
Oh, absolutely. It's the bad boy of volatility. It breaks hearts.
Historically, it's the poster child for cyclical stocks. It's a roller coaster.
Total boom and bust.
Right. You buy it, it goes up, everyone feels like a genius, then boom, memory prices crash because there's a glut and you lose your shirt. I mean, 2022, 2023, that was a bloodbath.
It was.
Why on earth should we believe this report's claim that this cycle is any different? Why isn't this just another bubble waiting to pop?
That is the multi-billion-dollar question, and the report argues the answer lies in a structural shift in what Micron actually is now. You have to separate the old Micron from the new Micron. For decades, Micron was a commodity manufacturer. They made DDR memory for PCs, for phones, stuff that was basically identical to what Samsung or SK Hynix made.
Like selling corn or oil.
Exactly like selling corn. If you're a corn farmer, you have zero control over the price. If the market is flooded with corn, the price crashes, your margins vanish. Doesn't matter how good your corn is.
And that was the old Micron.
And it was the old Micron. Supply and demand dictated everything. They were just at the mercy of the market.
Okay. So what's the new Micron? How have they magically escaped the cornfield?
Well, the report argues they've transitioned from selling a commodity to providing a critical infrastructure backbone for the AI economy.
That sounds fantastic, and I'm sure it looks great on a slide deck, but it also sounds a little bit like corporate marketing fluff.
I know. Critical infrastructure backbone. What does that actually mean in terms of silicon?
Yeah, what does it mean?
It means HBM, high bandwidth memory, specifically HBM3E and now HBM4. You have to understand the engineering bottleneck here.
Right.
Modern AI accelerators like NVIDIA's Blackwell chips or AMD's Instinct line, they aren't just limited by how fast they can do the math. They're limited by how fast they can move data in and out of the processor.
So it's a plumbing issue.
Precisely. You can have the fastest Ferrari engine in the world, but if you're feeding it fuel through a coffee stirrer, you aren't going anywhere.
You need a fire hose.
HBM is that fire hose. You fundamentally cannot run a top-tier AI data center without this specific type of complex stacked memory. It's not just storage anymore, it's an active, essential component of the compute engine itself.
So they aren't just selling a place to park data, they're selling the performance of the entire system. That creates stickiness.
It creates stickiness and it creates scarcity because it is so much harder to manufacture. You can't just flood the market with it like you could with old memory.
Right.
Which brings us to the data point in the report that I think really stops that boom and bust argument in its tracks.
What is it?
According to this analysis, Micron's entire HBM capacity is confirmed sold out.
Okay.
Through the end of calendar year 2026.
Wait, hold on. Let's pause on that. Sold out. As in, if I'm a hyperscaler, say I'm Amazon or Google, and I realize today I need more HBM for a new data center I want online in November,
You can call them.
I can't call Micron.
You can call, but the sales rep is going to tell you to take a number for 2027. The capacity is spoken for, allocated.
That completely flips the script on the inventory risk, doesn't it?
Yeah.
The fear was always, oh no, they built too many chips and nobody wants them.
Exactly. It changes the entire economic model.
Yeah.
In the old days, the corn days, Micron had to guess what demand would be, build chips, and pray.
Right.
Now they have an inventory lock. They have a backlog. Demand is just vastly outstripping supply.
Which I'm guessing gives them pricing power they've never had before. They aren't offering discounts.
Incredible pricing power. And for you, the listener holding the stock, it provides a massive safety net. If the inventory is already sold, the revenue for the next 12 months isn't some vague projection.
It's a signed contract.
It's essentially a signed contract, yes.
Okay, so revenue is locked in. That calms my nerves about the bust. But let's talk about the price tag of the stock itself. This is where I think most people get cold feet.
It's sugar shock, yeah.
The report mentions a price-to-earnings ratio, a PE, of 41.38. Now, traditional value investors, they look at memory stocks and they want to see a PE of like 8,
Right.
maybe 12.
Right. Single digits is the comfort zone.
Well, 41 times earnings, that just screams bubble. That feels like dot-com mania. How does the report justify that?
It feels that way if you are looking in the rearview mirror. And this is probably the single biggest mistake investors make with high-growth stocks.
Okay.
They look at the trailing PE, what the company earned in the last 12 months. But the stock market is a forward-looking machine. It prices in what's going to happen.
Not what already happened. So walk us through the math here. How do they rationalize 41?
The analysis section breaks this down really well. Yes, the trailing PE is high. But you have to look at the earnings estimates for fiscal year 2027.
2027. Okay, so we're looking about 18 to 24 months out.
And the analysts project that earnings per share, or EPS, could approach $37.
$37 a share.
So you take the current stock price, call it $4.35, and you divide it by that future earnings number of 37.
Okay, that brings you down to roughly 11 or 12.
Exactly.
Yeah.
So the stock is actually trading at roughly 11 times forward earnings.
Wow.
If you believe the growth story, you aren't paying a bubble premium at all. You're paying the historical average.
That is a massive discrepancy. 41 trailing versus 11 forward. It hinges entirely on whether that growth is real. Is it actually realistic for earnings to jump that much?
Well, the report argues the metrics are undeniable. Revenue is projected to hit $48.5 billion. That's a nearly 30% jump annually.
And the most recent quarter.
The report mentions Q1 2026 revenue was up 57% year over year.
57% growth for a hardware company this size. That is just massive.
It is. And earnings per share, projected to be up 324% to a run rate of over $32 for 2026.
Okay.
When you have earnings growing over 300%, a PE of 41 isn't expensive. It's actually cheap.
This reminds me of the PEG ratio, the price earnings to growth ratio. I use that all the time to sort of equalize things.
It is the best metric for this exact situation, yes.
And the rule of thumb is anything under 1.0 is considered undervalued. Where is Micron sitting in this report?
0.45.
0.45.
Yes. By that metric, it is screamingly undervalued. The market is pricing it as if the growth is going to stop tomorrow, but the order book says it's locked in for years.
Okay, I'll play devil's advocate again. The math checks out if they can keep dominating. But they aren't the only player. Samsung is the elephant in the room. They're massive, they have deep pockets. When Samsung wants a market, they usually take it. How is Micron holding them off?
This is where we get into the moat, the competitive advantage.
Right.
Historically, you're right, Samsung was the undisputed leader, SK Hynix was number 2, and Micron was a distant third. But the report details how Micron has leapfrogged to a strong number 2, capturing about 25% of the HBM market.
How did they manage to steal that much share?
It comes down to technical execution. The report notes that Micron's HBM3E is reported to have 30% better power efficiency than Samsung's.
30% better.
Yes.
Okay, let's put that in context. For me, a consumer, power efficiency is boring. My phone battery lasts 10 minutes longer. Who cares? But in a data center.
In a data center, power is everything. It is the single biggest operating cost. These AI clusters consume gigawatts.
Yeah.
If you're Microsoft or Meta and you can reduce the power draw of your memory by 30%,
That saves you millions of dollars.
and it means less heat, which means less cooling, you can pack more compute into the same building. It's not a nice to have, it's a deciding factor.
So NVIDIA wants the most efficient chips possible because it makes their product look better.
Exactly. Meanwhile, the report points out that Samsung is actually struggling to qualify its chips for NVIDIA. They're having yield issues.
So Samsung is fumbling the ball, And Micron is right there to scoop it up.
Precisely. But there is another layer here that I think is the most fascinating part of the report. It's the geopolitical premium.
I saw that. The report says Micron is trading at a much higher multiple than its competitors.
Yeah.
SK Hynix at 17 times earnings, Samsung at 19. Micron's double that. Why?
Because Micron is the only Western hedge.
The only American option.
Think about where SK Hynix and Samsung are. South Korea.
Right next to the 38th parallel.
Exactly. There is inherent geopolitical risk. If you are a massive U.S. tech company, an Amazon, a Google, and Apple building critical infrastructure, can you rely 100% on a supply chain in a potential conflict zone?
You can't. Your risk department would fire you.
You need diversification. You need a secure U.S.-based supply. Micron is literally the only major player that offers that. And so investors are willing to pay a premium for that safety.
That makes perfect sense. It's an insurance policy. You pay extra for the house that isn't built on a fault line.
It is. And that insurance policy is paying off handsomely in the profit margins.
Which brings us to what the report calls the smoking gun. I love this part because it's a financial metric I don't think enough people pay attention to.
Right. Everyone looks at revenue or net income, but cash is king.
So what's the metric?
It's cash flow from operations as a percentage of sales.
Explain that for someone who might not be a CPA.
Sure, it's a measure of efficiency. For every dollar of revenue you bring in, how much of that dollar actually ends up as cold, hard cash in the bank after you pay for everything?
Okay. So where was Micron before this super cycle in, say, 2023?
In the trough of 2023, this metric was between 10 and 15%.
That's tight. They were basically burning cash just to keep the lights on.
Exactly. And now, what does the 2026 report say?
I'm waiting for it.
It is sitting at roughly 50.6%.
Whoa, 50.6. They're keeping 50 cents of cash for every single dollar of sales.
Yes. And just to frame that for you, manufacturing companies do not do that. That's what you see in high-end software businesses. Think Adobe, think Microsoft.
So structurally, they are a hardware company, but financially, they are performing like a SaaS company.
That is the core argument. It tells us two things. One, their operations are incredibly lean. But two, and more importantly, it indicates zero pricing pressure.
Explain that connection.
Well, if you have to give discounts to sell your product, your margins drop, your cash flow drops. 50% cash flow means customers are so desperate they are paying full price upfront, no argument.
It's pure leverage. Here's the price, take it or leave it.
Compare that to Samsung, which is hovering around 30-35% because their foundry business is bleeding cash. The report literally calls Micron a pure play profit machine.
That is a powerful image, a profit machine.
Right.
Okay, let's zoom out. If we accept all this, where does the stock actually go from here? We're at 435 today.
The forecast is incredibly bullish. The technical analysis suggests momentum points to $500 plus in the second quarter of 2026.
So 500 is the short-term target. That's just around the corner.
It is. But the bull case price target, and hold on to your hat here, is $969.
$969. Nearly $1,000 a share. That's a double from here.
It is. And that target is based on peak earnings estimates for FY27. It's a scenario where the super cycle extends even longer, and there's one more mechanical factor that could push it there.
The shorts.
The short squeeze.
I imagine there's still plenty of people betting on that old boom and bust cycle to come back. They're shorting the stock.
A lot of skepticism is baked in, but the report notes that short interest is rapidly declining. As the stock breaks out, those short sellers are in a world of pain. They're forced to cover their positions.
Which means they have to buy the stock back at these high prices.
Yeah, creating artificial demand and pushing the price even higher. It's fuel on the fire.
So the report's final verdict is pretty clear.
It is. Selling Micron now at 435 would be like selling NVIDIA in 2023 just as the AI wave was starting to crest.
That is a nightmare scenario for any investor. Looking back and realizing you got off the train 3 stops too early.
And the report concludes that with capacity sold out through 2026, earnings are effectively guaranteed for the next 12 months. The recommendation is a definitive, strong buy.
It's rare to see such a clear-cut case. So let's recap for the listener who is staring at that sell button, sweating bullets. What do they need to remember?
First, don't let the all-time high stare you. The business model has changed. This isn't the old Micron.
Right. It's not corn anymore.
Second, the numbers back it up. You aren't paying 41 times earnings. You're paying 11 times future earnings for a company with this kind of growth. The PEG ratio proves it's undervalued.
And third?
You are buying the only major U.S. supplier, the Western hedge, in a market that is completely sold out. The sold out sign is on the door for the next year. You have visibility.
So watch that $500 level in Q2. That seems to be the next major checkpoint.
Definitely. And here's a final provocative thought to leave you with.
Let's hear it.
If Micron really is generating software-like margins, 50% cash flow, and it's essential to the AI economy, does the market eventually stop treating it like a cyclical memory company altogether?
What do you mean by that?
I mean, do we stop waiting for the bust? Does Micron eventually get re-rated permanently as a tech utility? Think about your electric company. It's stable, profitable, essential.
You don't worry about the water company going bust.
Exactly. If Micron becomes the electric grid for AI, the valuation we're seeing now might not be a peak. It might be the new floor.
A tech utility. That is a fascinating way to think about it. It definitely changes how you look at the daily price swings. You're not betting on a chip. You're betting on the grid itself.
It changes the whole paradigm.
Well, there you have it. The case for holding on. It sounds like holding tight might just be the hardest but smartest move. Thanks for taking this deep dive with us.
My pleasure.
And to our listener, keep your eyes on
Don't forget to like, share, and subscribe for more.